Hello everyone, and welcome to the EcoInvestment update for January 13th, 2019. And I hope your new year is off to a great start. What I express here is only my personal opinions and observations, having been around, observed, and within the financial industry since 1981. You observe a few things, you learn a few things, you do some things properly, you do some things improperly, but hopefully you always learn from the experience. I think this will be an interesting one today, just an update on markets and things. As I said in the last EcoInvestment update, bull markets like we've had from March of 2008 through early September of 2018, they don't fail because they drop. They fail because an attempt to rally back takes place and oftentimes falls short, thereby reinforcing a bear market and turning more and more public sentiment negative. We had a big drop from about 27,000 down to just below 22,000. And we've now rallied up to about 24,000 and change here. Pretty nice recovery. The question everybody wants to know is, are we in a new bull market, or is this just a reflex rally from our first really big high-speed decline of January of 2000, December, the horrendous December of 2018? Well, there's things to consider when you weigh the evidence and you make choices. Number one, in January usually is a month with a strong upward bias to investment markets. Reason being, new investment monies come in from retirement funds, pension funds, all sorts of money flows, people funding their IRAs for the year. There's just more money flowing in on balance than usually flows out. That creates an upward pressure or drive on prices. But that has to offset against our current climate here, which is a climate where we have a presidency that's under increasing attack. We're in the middle of the longest shutdown. Oh, maybe we're in the middle. Who knows? Longest shutdown in history, with very strong personalities and very entrenched people on both sides, the Democrats and the Republicans here, and it's making for a very bad climate. Washington, D.C., we have trade problems. We had growing competition in high technology. It's been affecting companies like Apple with derivative knock-on to NVIDIA, chip makers, other high-tech fabricators, chip fabricators. It's been a very difficult month. We've had some declines in banking and in the transportation averages. In particular, we've had a little bit of a reflex rally in oil here, which has helped to provide some upward push in the markets. But the question you have to ask yourself, will the outlook be better? Will people be feeling more optimistic if the market hits a new high, or is it just going to be impossible to achieve a new high because people on any kind of significant rally will be looking for a chance to hit the exit doors and not to get aggressively long with new positions? So this is the thing we have to weigh off. Yes, bull markets climb a wall of worry, it's true, and they exit on the glory of trumpets. So we have to decide, is all the bad news out? Is it baked in a cake? Is competition going to lessen in the future? Are the trade battles going to be resolved? Those are the issues that we have to ask. Look at the reports for retailers for the month of December. As much as ShopperTrack and some of these other companies that follow trends in Christmas shopping and stuff were saying how great bricks and mortar shopping was in December, look at companies like Macy's. Look at companies like Kohl's. Look at the hits these companies have taken since they reported their numbers for December. They have been absolutely decimated here. Let's be real about things. The whole economy is changing towards an internet-based economy because it's much more efficient in nature. I don't expect that trend to continue. And there's lots and lots and lots and lots of jobs that are dependent on a strong retail sector. So we shall see on there. Now, a lot of people ask me, so the jury is still out. Bottom line, we still have to wait. I wouldn't turn positive on the market unless it made a new all-time high, and then I would assume that we are in a really huge speculative bubble, and then the sky will be the limit at that point. You know, you want to talk Dow 40,000 or something like that. That's the kind of runaway thing that could happen. But in the face of what's going on today, even in the face of that strong employment number of December, markets look ahead. They don't look behind. Okay, and this market saw something in in December of 2018 that it really didn't like. So it still remains to be seen what that is. I lived through all this drama of Watergate in the 1970s and a president under increasing pressure. I saw the toll that it took on the great bear market and recession of 1974. So like I say, the jury's out. It remains to be seen what happens. A lot of people ask me about gold and silver and my thoughts on that. And is it worthwhile having that in a portfolio? And rather than give a straight out answer yes or no, I'm going to give you an example that I hope I've used several times here in the past that I think exactly shows the power of precious metals in a portfolio in terms of maintaining your purchasing power. And this is the important thing. The purchasing power of the United States dollar is 10% of what it was at the turn of the century, and this is a fact. But I want to show you the power of gold and silver in terms of preserving and protecting your purchasing power. You know, a gallon of gasoline in 1929 cost 20 cents a gallon. A gallon of gasoline costs about $2 today, average across in the United States. Now, if you had 2 silver dimes in 1929, guess what? You pull up to the gas pump, you can buy a gallon of gasoline. You turn over your 2 1929 shiny Mercury dimes, 1929 dimes, and you roll away with your gallon of gasoline in your Model T Ford or your, in the future, your Model A there, right? You're happy. 2 silver dimes gets you a gallon of gas. If you pull up to a gas station today with 2 dimes out of your pocket and try to buy a gallon of gasoline, what's going to happen? They're going to tell you that, brother, you are $1.80 short on that gallon of gasoline. You need to reach into your pocket and pull out another $1.80. But you know, if a person came forward in time travel and had those 2 silver dimes today from 1929 and walked into a coin dealer, he would get $1.20, 12 times the face value of each of those dimes. He would walk out the door with $2.40 in American money today. If he went and got in his car and went to that gas station, he could buy that gallon of gas today from those 2 silver dimes and have 40 cents left over. That's the power of precious metals in preserving purchasing power of your money. Now, it's very important to say that this has held true throughout history. At times it goes a little kilter as people get too greedy or get too scared of metals, and certainly everything gets pulled down when you have crashes, at least temporarily. But if you look at the island of debt, as somebody posted over the weekend, the island of debt that the United States is floating on in the world today, I would tend to put my money on something that's held its value through time and been a perfect preserver of purchasing power. Okay? I think that pretty clearly answers the question. Now remember, you may think that the weird thing is, as Einstein says, everything is relative in the universe. Now you might think to yourself, gold and silver are going up and down in value, but actually it's the rest of the world, the United States dollar, and things moving against that. In other words, think of gold and silver as stationary yardsticks of value, and everything else moves against that. Isn't that interesting when things crashed apart in the real estate crisis of 2008? That when the Federal Reserve came in the Treasury and started printing and monetizing all this bad debt and exploding the number of U.S. dollars by taking on purchasing debt, bad debt from companies, and replacing it with good dollars. Isn't it funny that gold and silver had the big jumps at that point in time? They were adjusting to this inflow of cheap money that was rolling in to rescue our economy. Well, that's enough for this week. Thanks for watching, everybody. Stay tuned, and we will know in the fullness of time what happens. Enjoy the rest of your January.